Thierry Samlal from PMML. Today I would like to present you the market statistics for multifamily in the province of Quebec for the month of January 2025. A market with a lot of volume last year. We had extremes. It was a record year as far as volume in the province of Quebec for multifamily sales in 2024. This was caused by two main factors. First of all, the fact that we were able to importantly increase the rents in 2024, and we anticipated important rent increases in 2025. And second of all, because the interest rates were dropping and market confidence was at the same time increasing for the sellers and also for the buyers, which both had a lot of confidence in the market. So the sellers were putting their properties on the market for sale and the buyers were buying. All of that in a context where return was very, very low. We're continuing that statistic in 2025. We saw more than $500 million worth of transactions in multifamily for the month of January 2025, and that's extreme amount when you're looking at the market. January usually is a more slow period. Why? Because in the province of Quebec, most of our leases come up to term in July, 30th of June actually, and starting January, you're in the renewal period where rent control gives you the pro forma of what you could do as far as rent increases, and then you apply it to your building, right? So that's when usually it happens. And usually owners, what they do is they wait for the TAL, which is the organism giving the parameters of the rent increases to the market. They wait till the end of January to do their rent increases. But they didn't do that this year because we were able to anticipate rent increases way before their time because of the publicity around the pre-calculations of what is possible and not possible as far as rent increases in the province of Quebec. I'm thinking about the Corpic that gave a market opinion in advance. I'm thinking about the newspapers and the medias, and forget the newspapers, there's no more paper, but you know what I mean. The medias that were in advance taking the market information and publicizing a possible rent increase even before it happened officially, giving a lot of, once again, confidence to the market to compute those rent increases in advance and pro formas that the buyers were doing. So that translated in $500 million worth of transactions in the province of Quebec in January, which is huge, right? Let's think about one main transaction in that 500 million, a transaction of 143 million, a transaction that was very important for the capital region, what we call la région capitale nationale, well, Quebec City basically, and the overall area around the Quebec City, where there's a lot of transactions taking place these days. So we have two locals that transacted. The buyer is Société Immobilière Bélanger, which had about 2,000 units. And what they used to do is they used to buy a lot of buildings, renovate, optimize them, offer a much better lifestyle to the tenants, and we're very happy with it. And they had that model that they were applying all over the province of Quebec. They did it before in other places. So they were able to put that forward when they offered to the seller, saying, well, listen, we could buy 1,057 units at one time, a transaction of 143 million, 39 buildings. We could do this purchase. We've done it before. And by accepting our offer, first of all, you're accepting a buyer that's able to do a transaction of that size. And second of all, since you're a builder, Mr. Seller, the seller's Logisco, a major builder in the capital region of Quebec, in Quebec City, and building a lot of new assets and has a great reputation. Well, Mr. Seller, at the same time, I'll take those buildings from you, and if ever this goes public, well, people have a lot of confidence in me as a purchaser because I've shown that I give a good lifestyle to my tenants. So it was a win-win situation. And the builder, Logisco, now is going to take that money and redevelop in the regions where the buildings of the purchaser are already, creating a larger gap between the existing rents of existing buildings and newer built. You know that famous gap between the existing asset and the new build? More that gap is far, more that this guy down here, the buyer, has capacity to increase the rents over time. So it was an ecosystem, and that's what I find interesting about that transaction is it auto supports itself, and it's logical to go that way. And you're getting financed by a local that's picking back up your business and that wants to keep the reputation that you already put in place. So great transaction, very nicely done. So that's one. Now, another main transaction that took place now in Saint-Constant, South Shore of Montreal, close to Brossard, not close to any major public transportation, but in an area where development is important. 2024 construction. Now, this was picked up. It was a distressed property, a financially distressed situation where the seller had to sell. The buyer is an optimizer, usually buys these buildings to optimize them. But being a 2024 construction, the optimization model is completely different because there's not going to be renovations of the common areas. There's not going to be renovations of the units like the buyer usually does. There's only going to be optimizations of the rents. And that's something that you have to consider when you're buying a new build, saying, well, listen, I might be leveraged a little bit more on it, meaning that, going through the MLI program or whatever financing program through the CHMC to permit you to reduce the initial investment in cash. It could be interesting just to pick up an asset and just work off the administration part of it, and simply work off managing the rents than having to renovate. So this is probably what happened here. A transaction close to $52,250,000, 165 units, about $317,000 a door. Great transaction. Going back to Quebec City, 232 units, 13 stories, 232 units, sold from a private to a private, okay? Now this is important because at the moment I'm doing this video, we already did the Quebec Apartment Investment Conference and we gave the information to the public. And what we were saying basically on stage is that the institutional players are on the back lines right now. They're looking to see what's happening in the market. They're in a position where they want to buy new apartment buildings, but they're not available. So they're getting rid of their smaller or larger stuff, which is existing properties that they can't pull out any rent out of them anymore, because if they go further on pulling out rent, it could be a public liability as far as their reputation. So most of them sold out already what they had in 2023, right? So right now they're in the waiting positions, and that's giving more opportunity for the private buyers to purchase these main assets. And the private buyers are the ones that sustain the multifamily market in the 50 to 300 door portfolio range in 2023. It's the private buyers that sustain the market. And Quebec is mostly a private buyer market. There's a lot of volume in the province of Quebec. Quebec is still number one in volume creation in the whole of Canada as far as multifamily. So it's to take in consideration that if you want to invest in the province of Quebec, you're investing in a good asset. You're investing in a good territory, although there might be differences if you're outside of the province with your legislations. It's pretty easy to adapt once you take a management company. It's not rocket science to come into the province and buy. It's the same financial system as far as financing, and then you just put a local manager that's going to take care of all of your business and take care of the gap between your legislation and the one in the province of Quebec. So anyways, interesting transaction. Now, let's go to Longueuil, South Shore of Montreal, a portfolio of 5 buildings, 24 units each, comprising 120 units in total, 1983-1984 construction. Possibilities to renovate the building. This transaction took place at close to $194,500 per door. meaning a transaction of 23,350,000 at a cap rate of 3.64 and an asset that was already financed MLI Select by the owner. So the owner put a 100-point affordable MLI program in place, pulled out all of the equity of the asset, then turned around and sold it to this buyer. And why did the buyer see opportunity? First of all, because this buyer right now has a longer term vision of the market. When you're picking up an asset and you're picking up a lot of land that goes with that asset, this was like a private domain. It's a lot of land. Well, you're in advance looking at future value. Let's go 30 years down the line. If you have that much land, you could start demolishing buildings and rebuilding much larger assets. And that's part of the vision of the buyer. But beforehand, before that, there was a large gap between current rents and the minimum MLI rent for that area. So just picking up between that gap is going to take maybe 2, 3, 4 years for the buyer, and that's a first takeout. And although the MLI program is 10 years long, well, that's 4 years, maybe 3, 4 years in the program. There's left maybe 6 years to go. Then there's possibilities of maybe thinking of renovating the assets over time. And then there was excess land on the property, so possibility of maybe building on it. So interesting transaction. There's a 13-plex that sold for $592,000 per door in Outremont. Yes, so that's pretty incredible. We were not part of that transaction, but I wanted to bring it forward because we really double checked the transfer of property document and active sale, and we looked at it as, are we really right? And we were sitting down with the analysts here, and do we have this right? I mean, it's on paper, and then we double checked, and yeah, it's a transaction that took place at $592,000 per door. It's almost condo grade value. Now, the particularity of this project, it's in Outremont, a very sought for area by certain buyers, and it's directly in front of the metro station. I mean, you could cross the street and walk right into the metro station within a minute. And transit-oriented development is much so important. There's going to be a lot of announcements this year for transportation changes in the province of Quebec as far as development. If you have a building in those areas, or if you want to purchase in those areas, I mean, think of it seriously. It took a lot of time, but now our metro lines are being extended. It took like 15 years of discussion, but now it's being done. There's expropriation that took place in the eastern part of Montreal, northeast, and now we have the blue line, which is being extended. We even have total shopping centers that were demolished to put new metro stations on. And that's going to bring a lot of activity to those areas. And when you put a metro station in place, well, then you're eliminating a car. If you eliminate a car payment of $300-400 per month, that's $300-400 per month extra available for rent. So think about that. Sainte Foy, let's go to Quebec City, a 33 unit, $147,000 per door. The market is increasing price per door in that area. Downtown Montreal, Lambert-Closse, 1931 construction. 24 units, 3 storage, $187,500 per door. That's cheap for downtown Montreal. And I'm pointing because it's right over there. I mean, I'm in downtown Montreal right now. There's a lot of opportunity for vertically built buildings in the future. So when you're purchasing an asset, I mean, even if you have a 5-10 year term, at the end of the term, there's possibilities of maybe hoping to vertically densify the asset. And if the cards are played right and it's the right buyer that buys, and if the city is in the game, well, you could find yourself with an asset that's worth much, much more because you could vertically densify. And then the opportunity is for you, the seller, and also the buyer, to pick up a property that's available to build a high-rise on. Plateau Mont-Royal, very good area for rents. 1915 construction, the 10-plex sold for $434,000 a door. That's almost the price of a new building in the first outskirts of Montreal. That's extreme. But the plateau is the plateau. And when you have a refurbished product in the plateau, you're attracting the right clientele. And when you attract the right clientele, you have good net revenue, and then you can get good financing. And that's the name of the game these days. It's financing. It's how much financing you can get on an asset. It's important. Limoilou area of Quebec. I'm jumping between Quebec and Montreal because that's where the transactions took place. I mean, those are very important transactions. 1973 asset, 32 units, 112,500 per door. Now I chose this out of the pot because it's a transaction that took place personally between two private buyers. Okay, when you're seeing a price per door that low, you're either linked buyers, same companies, same shareholders, or same activity, or you're not represented because it's a very, very low transaction price per door. It's way below market value. So sometimes owners think that they could get a better price on their own, but in this case, it's very it, it's incredible the difference in price they could have got if they went to market. That's what I want to say. Granby is an area that I want to talk to you about. It's going towards the eastern townships, so from Brossard, from the South Shore of Montreal on Highway 10. If you're driving to go to Adirondacks, etc., in that area, if you're driving towards Sherbrooke, basically, well, in that case, you'll go through Granby. And Granby is a big city, first of all, because it has a big density of population, but it has a lot of industries in Granby, and it's a very large territory. It's close to the ski hill in Bromont. It's close to the Eastern Townships lifestyle, where you have a lot of cottages, there's a lot of cachet to that area. There's a lot of lakes. There's a hunting. There's skiing. There's cross country skiing. It's an area which is good to live, basically. And Granby has a good capacity of increasing rents over time. And this now we're talking about a two-story building, 12 units, went for close to $296,000 per door. Interesting, because when you're looking at a smaller asset and you're a smaller investor and you want to buy new, go towards brick and wood. Why? Because brick and wood is going to permit you to have less variations in expenses over time, less opportunity to increase rents because you don't have an elevator, you don't have an inside garage. But still, is that what the population wants? I mean, not everybody wants to pay extra for an elevator and pay extra for indoor parking. People want a nice place to live, and they want to be able to rent something new. So buying something, a smaller asset like that, could make a lot of sense. I hope this information is going to be good. You could use it in your personal transactions. If ever you have any questions on the market, please feel free to contact me. We could do an evaluation of your property if you want to sell. Market is in movement. Stay active. If you have money aside, it's time to invest. Invest it in the multifamily market, and over time, you'll be able to pick up two things: create equity. Equity is being created really fast, has been created really fast in the last few years, and also pick up a return on your investment. So take great care, and we'll speak next month to discuss once again multifamily property sales in the province of Quebec. Take care.